Today, my guest is Scott Krone. Scott is with Coda Management Group, and we are going to speak with Scott about how he moved from residential properties into storage facilities and the advantages in storage facilities. But first, I want to remind you, if you like the show, we would love to hear from you. If you can like, share, or subscribe, and also if you'd like to see how handsome our guests are, please check out our YouTube channel, Commercial Real Estate Pro Network. All right. With that, I'd like to welcome Scott. Scott, how are you doing?
I'm doing well. Thanks, Darren, for having us on this very cold and frigid day in Chicago.
Yeah, I think we might want to note the day. Today is January 30th, and record cold temperatures, right? What is the thermometer reading there in Chicago?
Unfortunately, it is reading minus 50 with the wind chill, so that is actually colder than in Antarctica today.
So if you ever wanted to take the kids to the North Pole or I guess the South Pole, you can say, it'd be just like this. So you've got that off your bucket list, huh?
Exactly.
So, well, anyway, I'm glad you're inside. I'm glad you're warm, and looking forward to talking to you today. But before we get into talking about self-storage and that, if you could do myself and the listeners a favor and share a little bit about your background.
Absolutely. My pleasure. I began in real estate when I graduated from college and began pursuing a master's of architecture from the Illinois Institute of Technology in 1991. I was fortunate enough that my professor actually owned a real estate development design and build firm. And so a lot of the work that we did in class was actually real projects that he was working on in his office. And so I got to work on real life projects right from the beginning. I was his TA. And so my master's thesis was actually a 400 unit development that he took 6 years to build. And I would work on it in his office in the morning until noon, then go to class until 6, and then go home and do homework, which was more work for his projects. So I was basically working from him from like 7 in the morning until midnight for 3 years, and then 3 years more in his office. And so my whole background was really in residential commercial real estate. I worked for him for 6 years, and then in 1998, I began Coda, and we were a design build developer. And so we did a wide variety of projects, anything from speculative single family homes to multifamily mixed use. We even did some churches. And so just a wide range of things. And everything was, plugging along. We're now in our 20th year. But, obviously with the crash, the whole market conditions changed. And so in 2008 and 9, the lending conditions no one was doing speculative residential. And so everybody was moving into apartments or other assets. And that's when we began buying multifamily and distressed notes and things along those lines. And it was in 13 that I was asked to evaluate self-storage facilities. And that's how I became familiar with that, and then looking at the opportunities within self-storage.
Got it. And is that where you're primarily focused now, is the self-storage?
We have two divisions. So our retail division is focusing on building for clients. So, we will do luxury homes, or right now we're actually doing our third church. But on our investment side, we have sold all of our apartments, and we are solely investing in self-storage at this point in time.
Wow. So how long were you in the multifamily then?
From 91 until we just sold it last year. So from 91 until this past year.
Well, I don't know what 91 was like, but I'm assuming you got out at a good point. At least the numbers are considerably up if your market was like the rest of the country.
Yeah, and the reason I chose is I felt that over the course of the time frame that the cap rates had compressed down to their lowest level, and so we were going to gain the greatest yield at this point in time. Right now, I see the apartment market is oversaturated, and people trying to acquire at very low cap rates, and so that's where I felt it was a good time to get out. The other multifamily that we've done in the past was more of a condominium and townhome and things that which we sold. But the apartments that we held, we just recently liquidated them.
Got it. Got it. So you've been doing the self-storage now since 13, correct?
Correct. Mm-hmm.
And I'm assuming that the numbers are caught your attention, or fairly lucrative, or there's something extra appealing for somebody to have been in the multifamily as long as you were to have fully gotten out. Can you talk a little bit about what you see as far as if you were to compare the multifamily to the self-storage?
Absolutely. So the underlying principles are the same. People will say to me, "Well, I understand apartments, but I don't understand self-storage. Help me understand self-storage." And my first response is, it's apartments without toilets. And so it's the most basic concept of an apartment that we can possibly have. We don't have to worry about plumbing. We don't have to worry about all the emergency issues that tenants have. And so it is a lot more simplistic of a model. So from that sense, if we take that concept and apply it to every aspect of comparing apartments to self-storage, it's the same. So like when we were doing the 400 units, our total costs were, we sold it for over $100 million. If we have 400 self-storage units, we're literally at a fraction of the cost. So our typical building is between 80 and 100,000 square feet, and we'll have somewhere between 600 and 800 rental units. But our total cost in it is, a fraction, a tenth of what it would be if we were to have that many apartment buildings, or apartment units, I should say. And so from an economic point of view, we have a lot greater flexibility to hedge or diversify our portfolio based upon different locations. The risk in our mind is much lower because we don't have to yield as much capital. And so we can gain the rental capacity out of it without having to expend as much capital.
Got it. Are you doing new construction, or are you converting buildings into storage space, or?
What we are doing is we're doing all Class A facilities. So we are taking existing buildings and we're converting them into Class A self-storage facilities. So what we're looking for is either warehouses, industrial space, office, those sorts of things, in very strong demographics where the demand far out exceeds the supply. And then we can pick our locations very specifically based upon the location. And so the challenge is just finding a building that meets that criteria in those areas. So we're predominantly in the Midwest. We're now in 3 states. And people have asked us about Florida, Texas, California, those sort of markets, but we see a very heavy saturation in those areas. And so those are the markets we tend to avoid, but we go into underserved areas within a city, and we can focus on those specific markets.
Got it. You mentioned converting existing structures. A couple of things that a couple of questions I've got. When you were building the apartments and that, I'm curious about the design lead time, and this. I'm thinking of this from a standpoint of you being an architect and having spent all the time, from concept to a completed project. The time it would take to do something like that, whereas if you have an existing structure and the times that it takes to come up with your plans and convert that, is there a compressed timeline with an existing structure?
There is a compressed time frame. And when we were doing apartments, most of the time you have to go before and get a PUD, which is a planned urban development. And you could spend a year and a half, 2 years, just getting the approvals to have the right to build the project that you want, whether it's condos or apartments or whatever it may be. The first project I was telling you about, we literally worked on that for a year, refining it, fine-tuning it. It started off as 1,000 condos and got whittled down to 316 condos, 64 townhomes, and 16 single-family homes. And so the program really changed dramatically during that course of the year. And there's a lot of expenditures and risks that you're putting forward, because ultimately your density, how many units you get, will dictate if you pay too much or too little for the land. And so there's a lot of risk in trying to negotiate that with the municipalities. What we try to do is find properties that are already zoned for storage, but they're not having the current use. So for instance, this past week, we went to contract on a property and it was already zoned for it. So we don't have to get the zoning for it. We have it as a right. So we can come in and just submit for a building permit. The second part of it is that we bought this building for $9 a square foot. I can't physically build that building for $9 a square foot.
No way. And I'm assuming, and then my next question is when you, before I jump into the next question, so the time frame, so you don't have any of that pre-construction time because the building's already existing and it's already zoned for the use that you intend, right? So essentially, when you close, you can submit design or whatever the alterations or whatever, get your permits, and you've eliminated all that pre-design work or the time, I guess.
Exactly.
Yeah. Well, and I bring that up just from a standpoint of I recognize, and we're kind of coming through a major build time where, there's all sorts of cranes up in the air and there's all sorts of new product being developed. And I know people that are trying to get permits, and they've been waiting for, like you said, 12 months just to get, permits. So you've had to, submit a complete set of plans. You're 12 months waiting to just get a permit. And by that time, the market's changed, I mean, like you said, you started off with 1,000 unit project, you ended up with 300 and change. And I'm guessing that the numbers were considerably different from what you projected going in at 1,000 as opposed to what you came out with at 316 based on that, just the sheer, I mean, that's almost a third of your numbers there. That's huge.
It is. And that's the risk. And I remember talking with my employer at the time, like, how much risk that really is. And how do you mitigate for that? And it was ironic because at that point in time, we were building very luxurious condominiums in terms of the price point. And, I asked him, do you consider building at a lower price point in order to mitigate some of that risk? And, he said, well, this is the market, this is where we are, and this is the type of product that we're building. And it's ironic that now I'm building the least expensive apartment that you could possibly build,
right.
A metal box. And so, that it is sort of, ironic that we look at it that way. But, the other thing I really like about the self-storage is that it's not dependent upon the economy. When I first began looking at it, we were still in the thrust of the recession, but they were thriving, and they tend to thrive more in recessionary markets than they do in bullish markets. And so what we saw was that either in an up or down market, the principles of the underlying economics of self-storage remain pretty constant. The biggest factor that we have to take into consideration is saturation point.
Got it. So you're analyzing the market. You're finding supply and demand gap. I mean, it's kind of what I've heard you say is your market. You're aware of the market. You're aware of what the supply is. You recognize there's demand for additional supply. And are the buildings, are they primarily warehouse, or are you finding like old retail, or is there a specific kind of I'm assuming you guys have a sweet spot of a target. If I dropped you in the market, you could kind of assess what might work.
Sure.
Can you describe kind of what that looks like, or is that your secret sauce? Or
no, the typical building, as I said, is around 80 to 100,000 square feet. We have purchased the old Lincoln Log Factory. We have purchased the first fireproof building in Milwaukee. We have bought another building that was medical storage in Toledo. And the building that we just recently purchased was an old warehouse. But we have purchased office warehouse. We have purchased warehouse. Any of those criteria, the first thing is really just, does it have the square footage and does it have the ceiling height that we need? And then we can convert any of those other things into it. We have looked at retail. The biggest challenge that we had was like big box retail is that the owners had some long-term Class A Fortune 500 tenants in them. And, despite the company going bankrupt and the company like downsizing, they still had a lease. And so they wanted to lease it out to us. And even at $2 a square foot, triple net lease, at 100,000 square feet, we just can't make the numbers work. And so what we really need is to buy a piece of property versus a lease in the traditional sense.
Right. Couple of questions to come up with that. Even with lease, I've seen all sorts of creative deals put together where you have some sort of a master lease or other things. Have you ever strayed from just a pure acquisition based on some sort of a contractual creativity, or is it pretty much you take acquisition up front, or you take possession up front and then you do with it as you like? Or has anybody ever presented anything more I don't know, complicated but creative and opportunistic?
We definitely have looked at creativity in terms of it, but not in terms of a lease structure, just because of the economics. $200 or $2 a square foot for 100,000 square feet, we'd be looking at $200,000 plus all the other expenses right off the bat, which is just too great. So some of the things that we have done to be creative, we've sold off cell towers, we've done historic tax credits, we do PACE financing, and we've established 2 opportunity funds for our 2 projects in Ohio are both in opportunity zones. And so those are things which we have utilized to help strengthen our investors' rate of returns. So when we model it, we don't take those things into consideration. We consider them bonus. And so, because not every investor might have capital gains to shelter in the opportunity zone, but if we have that tool or that resource to enhance our investors' rate of return, or to structure the capital stack in a unique and creative way, we take advantage of those opportunities.
Got it. I want to back up. You mentioned Class A storage space. Can you describe, I'm not as familiar with the different classes of storage space. When you say Class A versus Class B, or does it go A through D, or what's the...
Sure, you just thought they were all garage storage.
Well, no, I mean, I never even stopped to think of it. I mean, it makes complete sense, but I hadn't thought. I just want to make sure I'm not like assuming, I know what it is.
Sure, Class A is environmentally controlled, typically a new construction, where you physically can drive into the facility, the garage door comes down, and you can unload in a safe, dry, and secure, and warm environment. A Class C would be like first generation type facility, where it's out more in the country. You drive up, there's a fence around the facility, you plug in your number and you drive in, you have a garage door, you open up the garage door and you roll your stuff into the garage door.
Gotcha.
So Class B would be somewhere in between, where they might have some partially environmentally controlled and some that are not, but it's still the type of facility where you drive up to it. But they might have a heater at one end and an air conditioner at the other end, and it's more of a rural setting rather than a Class A would be in an urban setting type situation.
Got it. All right, so you find a structure, a building, you run the numbers, you make the offer, you close on it. Tell me about the extent of, I mean, are you essentially, you're buying a shell is predominantly the case, and then you go from there? And then I'm kind of curious, based on your answer there, what are you looking at? Is there like a budgetary from a cost per square foot range to renovate a property for your needs? You mentioned you don't have toilets. I mean, so the fact that you don't have all the plumbing involved has got to be, I would think, a huge savings. But I'm kind of curious if you could describe some sort of your cost range there of what you would expect on a renovation for to convert a property. Is that...
Sure. Now you're dipping into my secret sauce, but
okay. Well, yeah, I don't want to get too close to the Colonel's recipe there, but
yeah, we'll tell you that it's Thousand Island dressing and call it secret sauce. So, I mean, when we're looking at these, we are in essence buying the shell. And so when we go through and we're redeveloping the property, we're scrapping everything. So we assume that we have to put a new roof on it. A lot of times these situations, these buildings may or may not have a up-to-date heating and cooling system. A lot of times they're an antiquated boiler. So we're putting in new mechanicals, we're putting in all new HVAC equipment, all new lighting, which is why we get the PACE financing. Are you familiar with PACE?
Not exactly. If you could share with us I think is that the environment, or the kind of lead, or the low cost.
Well, it's
Please
through
tell
the
us what it
Department
is.
of Energy, and
Okay.
what it is it's Property Assessed Clean Energy Act. And so what happens is that you can get this money basically at low interest bond financing rate, and it is applied to the property taxes. So any improvements that you do to the building get applied to the property taxes. So from a bank perspective, it's treated as equity, but from a payoff perspective, it is a debt structure that you pay biannually on your real estate taxes. And so they increase your assessments, and then you pay it above the line as opposed to below the line. So banks consider it equity. And so we will put about $1 million worth of PACE energy improvements into a building. So that's a new roof, new lighting, new heating, new windows, installation. All those things get classified within PACE approved things. So if you take the existing building and then you say that you're going to improve the efficiency of the building by this much, then those efforts that you take will all qualify for it. So we can, get a much cheaper debt instrument than traditional financing, but utilize it as an equity instrument, which enhances our investors' rate of return. And so, you had a question?
No, I'm just you were. I understand conceptually. I'm just trying to think of, you start with the structure, you add your improvements. The improvements are under the PACE, right?
Mm-hmm.
And if I just for the benefit, as opposed to so the money for the PACE, or for the improvements, is coming through the PACE program as a loan, but it's considered equity because it's coming on the property tax side.
Exactly. There is no lien structure because the county, the local governing municipality has the rights to it versus through the property taxes and the assessments.
Oh, that's beautiful.
So we will do those sorts of things, and then we'll have to put in new sprinkler systems, and then also the lockers. So, the first part, the expensive things for us is to demo the building, the new roof, the new mechanicals, and then the lockers. And then, we can take, 6 to 9 months to build it out.
And the PACE, that's through the Department of Energy. So that's nationwide eligibility, or there's specific eligibilities as far as that goes for different. What is the eligibility requirements for that?
In essence, everybody is eligible for PACE, but in the reality of it is it's a multiple tier structure that has to be approved because of the fact that the local governing authority has to approve it in order to put it on the property taxes. So first the state has to approve it, but then the local municipalities have to approve as well. So for instance, Illinois is approved as a PACE state, but like the city of Chicago has not. So we don't have PACE incentives here in Chicago, but throughout Ohio, we do have it. And so that's how we were able to get it. So that is one of the programs. And then the opportunity zones that we use is through the Department of Treasury, which was just passed recently in the last tax law. And that was written and mapped out by each local state. And so within any city, there's a map that you can go onto. There's a PACE map, and then there's an opportunity zone map where you can put in the address, and you can see literally if that specific address is in the opportunity zone. And so that one is a little bit more specific. For instance, we looked at one property that was self-storage, and the property was not in an opportunity zone, but literally across the street was. And it was just, how it was mapped out. So, it's a little bit more happenstance.
Yeah, no, just a little bit that I've talked with people about and studied a little bit about the opportunity zone. I think that one of the takeaways I've come away with from it is, even if you aren't directly able to take advantage of the gains, and reinvest in an opportunity zone project, I would think that just because the property is in an opportunity zone, that will naturally attract additional investment around. I mean, if it is an area where people are pouring money into it. I would think that again, more investment into an area is going to increase demand or obviously supply demand or just improve the area. I would think that would be that's, I guess, from an all points way to look at it, as opposed to just with the benefit of your gains invested in and have the tax-free gain eventually has been kind of the way I've simplified it, I guess, for my own thought. I don't know. Do you have any kind of because you mentioned you've got some people that have gains and some people that don't. Is there a way that you've rationalized it or been able to explain it?
Yeah, absolutely. A lot of people associate the opportunity zone with bad neighborhoods or economically depressed neighborhoods. And I'm not going to say that those conditions don't exist. The way in which I understand it, because I've looked at the opportunity zones throughout the country, is that it is where the government, the local municipalities or the governors wanted to spur economic development and growth. So they might be in economically challenged neighborhoods, but they might also not be. For instance, our one in Toledo is in downtown Toledo. Our one in Dayton is in downtown Dayton. And there's tremendous growth going on in downtown Dayton right now. There's over 600 residential units that have been added within the last year within a quarter mile of our building. And so what they're really trying to spur is economic growth in those areas. And so it does spur people to invest in those areas because the logic is, even if the project doesn't do well, you will still defer your capital gains. We don't look at it that way, but that's my understanding of why they're trying to spur growth into these areas. Our model is, does it economically work? Yes. The opportunity zone in the fund is a bonus for the people that invest with us. So the way in which we have done it is we have our LLC where we have our investors. Our investors invest with us in our specific deal. But the people that want to shelter the capital gains, we created the opportunity fund. They invest in the opportunity fund, and then the opportunity fund then in turn invests into our company. And so that way, when we sell the asset, the money will go back in the opportunity fund, and then we can position it into another asset down the road.
Right. You've got the segregation of the funds there for the opportunity versus the non-opportunity funds there.
Exactly.
Got it. So let me ask you, so we've talked a little bit about residential versus self-storage, and in the cap rates. I mean, we talked about how the cap rates have been compressing in the multifamily. Are you finding that? Let me say it this way. So I'm assuming that the self-storage has its own cap rate in its market.
Correct.
Are you finding it to be a considerably higher cap rate than what you were seeing in the residential multifamily?
Not substantially more higher. I would not say it that way. What we're doing is, if you look at Class C, the cap rate is trading at 8 or 9%. I've seen apartments in ridiculously over, like in a Class B or C neighborhood, that are trading at 4 and 5 caps. And, people are thinking it's going to appreciate, and I don't see how it's going to appreciate that much more with the rental rates. So the big difference for us, what we do and where we're seeing our economic growth, is that we're buying and acquiring these things basically at a 12 cap. And so our total development cost will be at a 12 cap, but then we can sell them like at a 6 cap. And so we get a 6-point spread, as opposed to like buying it at a 9 and trying to convert it into an 8 or a 7. We are making our margin or huge spread based upon the fact that we're taking an underperformed building, we're buying it below replacement cost, we're making our money on the acquisition, and then through the development, our costs are going to be 65% compared to new construction. So we have a competitive advantage right off the bat in terms of what we can do with the rental rates in order to get it leased up faster, quicker, and then once we get stabilized, then we can refinance them and reposition them and pull the equity out.
No, I talk about a margin of safety. I mean, that's pretty sweet. Just the model you explained there. I mean, you have like you said, you can't build it for what you're buying it for, and the fact you're able to essentially be in at a 12 and the market's trading fully occupied kind of around a 6. That's a huge, that's beautiful right there. That's great.
So then we also get the cash flow out of them as well.
Yeah. Yeah. So on your strategy, are you guys buy and hold? Do you do you have like an exit strategy on these, or what's the go in and the get out?
We do. The whole premise of my real estate philosophy is the best time to sell is when you don't have to, because then you can really dictate, what your returns are. So, but our model is that we're going to hold them for 3 to 5 years, because the greater we can get them stabilized, then the higher yield we'll get off the cap rate on them. And so we also know that we've seen some self-storage portfolios trade at 4.5 cap when they had 10 or 20 assets in them. So we're building a portfolio of self-storage facilities. We began with Platform 1, which was 3 properties. Then we have Platform 2, which is 3 more. And now we just began Platform 3. And so our goal is to have 10 of these within the next 5 years. And we're on that path. And once we have that, then we will either begin selling them off or sell them as a package, depending on what yield we can get the greatest return for our investors.
Got it. And do you guys manage all of them yourself, or do you sub that out, or?
That's the beauty of it. My specialty is real estate. I didn't grow up one morning or, think one morning what, I really want to own self-storage when I was a kid. That wasn't on the top of my mind. So we do real estate. That is our forte. That is our secret sauce. We hire, the large REITs that manage self-storage on a daily basis, that they operate it. So we only hire national self-storage operators to manage our facilities. So we let them do what they do well, and we focus on what we do well.
Got it. I'm trying to think. Have you, in looking at the model? I mean, you said you are a real estate guy. Have you ever looked at management, or is that just never been your? I mean, never gone that way.
When we did the apartments, and when I began in real estate, the company that I worked for had a management component to it. So, I am familiar with what goes involved with it. The difference on the self-storage is it's most similar to a hotel, in the sense that the national call centers are very important in terms of your pricing, but your lead generation and your automation and all those sorts of things. And so there's a tremendous amount of capital that's required to create that infrastructure. And that's not something that we want to compete against the larger operators of it. And, we recognize that if we hire them, they're also going to become most likely our biggest buyer, because they're going to be familiar with the asset. And then, we can show, obviously they know the numbers, but, that is who becomes ultimately the buyers for us. Is, the better that they perform, then the better the return is going to be for us.
Oh, that makes complete sense. I hadn't realized that they were not only the operators, but also then eventual buyers of that. That makes complete sense. So do they operate it then under their brand? Is that?
They do. So it's no different than if you walked into a Holiday Inn Express or McDonald's or Culver's or, whatever, restaurant chain it is. You don't really know who owns the actual facility. You just see the sign. And so, when you make a phone call, you see the national branding on there.
Got it. And in that, do you then work with them up front when you're acquiring one? I mean, do they have certain space, facility or size, that fits their menu of available options, or does that make sense? I mean, So
there are there are industry standards across the board. So if you looked at, the major players in the space, or Extra Space is the largest self-storage facility operator in the country. And they became that through acquisition. They spent $1 billion acquiring facilities across the country. And that was what we saw trade at a 4.5 cap. CubeSmart's another large player. There's Life Storage, U-Haul. These are all the national brands that you can see out there. Public is another one. and they all have third-party management, which is they own their own facilities, but then they manage their other ones. But within that industry, there are standard sizes. So a 5x5, a 5x10, 10x10, 15x20, 20x20. These are all like standard size um, lockers that we have to put in. And so it just becomes a matter of, what does the office look like? What are the finishes? And then obviously the signage and those things.
Got it. Got it. So on a day-to-day operation, are you talking to investors? Are you looking for properties? What's a typical day like for you?
Oh, I wish I had a better answer for what a typical day. I think it's all those things. I mean, we have a director of construction who oversees all of our construction for us, and we have our director of sales and acquisition, who's primarily looking for properties and also working with our investors. But mine is, predominantly putting together the deal structures, working with the different lenders, also involved with our investors as well. But I do all the financial modeling and the strategic planning of the company on that sense. So it's constantly building relationships, either in terms of construction debt or long-term financial debt. In terms of refinancing it, learning about the new programs that are put into place. Like, for instance, the opportunity zones, I learned about that in beginning of August, and by end of October, November, we opened up our first fund, and then in December, we opened up our second fund. So, it's the speed of implementation that we were able to put into place there. This past year, that's how I learned about the PACE financing. These are all different. Those are the realms in which I'm looking to maximize our investors' rate of return. Those are the programs that I'm always trying to learn more about.
No, that's great. Just as a curiosity on the investors that are participating in the opportunity zone, are you finding, is there a significant, I guess where I'm going with, I always think of real estate people being real estate people, but the opportunity zone, when I read it, I'm looking at it as primarily somebody that's either sold a business or sold stock, is having a greater opportunity to participate in that.
It's any capital gains. So
no, and I get that, but I was just thinking from if you were looking at the kind of the makeup of the people that you found that have invested in it, is there a common place where their gains came from, or do you know that?
No, I wouldn't say there's a common. I mean, we had one that literally sold other self-storage facilities, and they're like, they built up their portfolio, and then they realize this huge gain. And so they wanted to stay in the space, and so then therefore they invested with us. Others are, we have a lot of investors coming out of San Francisco, and so they have a lot of tech stock gains, and so they're looking for ways to shelter it. And then others have just sold off other assets, and that's the beauty of it. And that's what we've told people. It doesn't really matter if it's a 1031 or if it's real estate or stock, or you sold your family's jewels or artwork, whatever it is. This is a way of protecting it. So the one most common commonality is that people have been doing the fund versus a 1031 exchange.
Right. Yeah, no, I was looking at it. I was going from a standpoint of, the traditional property guy would have a 1031 would be what would be the option. But this truly opened it up to, anybody from, stocks, bonds, selling your company, selling real estate, any and all of it. It sounds like an amazing opportunity if you have gains and you're looking for a place to park it. So that's great.
Absolutely.
So I'm looking down my kind of list of questions here, and I think what I'd like to go to now, unless there's something that you feel like I should have asked that I didn't, talk a little bit about risk. And I think I shared with you before we got started here that by day I'm an insurance broker, and risk management is something we're always trying to get a handle on. And as a broker, we recognize three strategies that are primarily in play, and the first being avoid the risk, second being minimize the risk, and then the third be transfer the risk. And insurance is a perfect example of that. I'm curious, in your business, if you could identify what your biggest risk is, and if you could then share with us how you go about managing that.
Well, I think most people assume that the market, economy is the biggest risk within real estate. And historically, it's true. Interest rates have a huge component to that in terms of, what sort of pressure that puts on. Obviously, we saw that with, the big crash, how the markets reacted and the fall of the real estate market based upon the banking industry. That is a component of what we have to deal with in terms of, and the way in which we mitigate the risk for that is we make sure that we don't over leverage what we're doing. And so we always want to maintain, 65, 70% equity to debt ratio. Prior to that, I mean, we were doing spec houses at, 90% debt, and just getting huge returns off, but it was insanity in terms of what they were allowing us to do. And there's huge risk in that. Unfortunately, I felt that the market was going to crash when I saw, doctors and investors coming in and being developers, or the guy that I hired as a carpenter in our first job, who was literally off the boat from Poland and couldn't speak English, was now my competitor and, doing homes much larger. And all of a sudden it was like, how did this guy, within a short amount of time become such a great expert that he could get these huge loans? I mean, it was the American dream. It was fantastic, right? But when I saw all those people flooding the market that, did not have a background and expertise in it, that's when I began pulling back. So that's how I mitigate risk, is I watch what the market is doing. And that's how we got into self-storage, because I was seeing an inefficiency within the marketplace and how to take advantage of that inefficiency. And the fact is that, the self-storage companies, the REITs, stopped developing because they couldn't have that overhead. They couldn't have a non-performing asset on their books for 3 years while they were waiting for it to become a performing asset, because it would pull down the valuation of their stock. And so that's where we come in, and we built that into our modeling. And so that is the first way in which we mitigate it, is not over leveraging. The second way is we really study the saturation. Recessions aren't my biggest fear. Our biggest risk is there's too many other facilities within 3 miles. And so a lot of that risk is offset by the fact that zoning will prohibit people from being able to accomplish what they want to do in terms of our product. If they can't get the zoning, then they can't build it. And so we, for instance, our one in Milwaukee put a moratorium on any new self-storage facilities. So in essence, it's going to be very hard for anybody to come in and be competitors to us based upon the fact that, we already have the zoning. And so, that's a competitive advantage that we have in that marketplace. The same in Toledo. They de-zoned the entire downtown area to make it mixed use. Our building that we bought was already zoned it. And so all we had to do was, maintain the existing zoning, and we have it. But literally across the street, you can not do that because the zoning would not allow it. And so those are the type of areas that we look for. And we make sure that, our competitors don't have that sort of ability to reduce our share in the marketplace.
No, that's incredible insight there. Having grown up in the Midwest, I think I was telling you before, I grew up in Kansas City, and I was always amazed. And I don't want to say I was always amazed, but looking back, how there was no kind of and I'm comparing this to Portland, Oregon, where there's a growth boundary. You can't build outside the boundary unless they expand the boundary, kind of thing, unless you have
Right.
a lot of. And but back in Kansas City, there was nothing like that. So that basically the value of your home was directly proportionate to how new it was. So every few years there'd be another development out further. And finally, what happened was kind of some of that core stuff started to die off. I mean, the mall that I bought every pair of jeans and tennis shoes and everything growing up at. I mean, it was a huge mall. It was a huge event to go there. They knocked it down. I mean, it was basically just and I was going, wow, that's crazy. But it was just anyway. There was nothing preventing anybody from coming into the marketplace and making something else more exciting or whatever kind of thing. And I think what you've just described there is being aware of exactly what the rules are, the rules of engagement, and knowing who can and who can and who cannot come in and create competition. That's kudos to you for paying that close of attention to that, knowing that. That's great.
Well, thank you. I mean, what you were describing is urban sprawl.
Yep.
And, that is the offset of urban sprawl, is that if you don't have, a comprehensive plan or the zoning in place, and the value of the asset is really, how new it is. And you see that not just in Kansas City, but throughout the country. And I think that's where, a lot of central core urban areas, which have retained the value or are now coming back, like our Toledo market in Dayton, those are both revitalizing and regentrifying, and they're encouraging people to move back in by making these hip new loft apartments for, that's where the housing stock is changing, because of the fact that the empty nesters are now looking for something that is less maintenance and more affordable. And so they're going down back into the cities versus, being out in the urban sprawl, which, I don't need a 4,000 square foot home for my wife and I, right? We need something smaller.
Right. No, it's an interesting dynamic. How everybody's kind of going back to more of a centralized model, and it seems to me that as long as Amazons and however people are buying stuff, they're buying a lot of stuff, and storage is always going to be in demand. I mean, I look at it as the living space gets smaller and smaller. Whatever those seasonal or whatever those things are, people have stuff that whether or not they need it or not, they're not ready to get rid of it, kind of thing. And if you have a smaller place and you're coming from a bigger place or whatever that is, that extra place, that the storage place makes a lot of sense.
Or the thing you give it to your children or your grandchildren and this or that, and just don't have the space for it now. But I mean, the other side, we see a lot of businesses using our facilities. Right. Because they need a warehouse type facility, but they don't want to buy a warehouse, so they can rent 200 square feet and keep their excess supply and inventory in there while they until they need it. So
and that actually brings up an interesting thought here. Do you have any kind of numbers or percentage of individuals to business clients, and do you have any kind of stats or off the top of your head, kind of is it 50-50?
Really varies per site. So for instance, our one in Chicago, the old Lincoln Log Factory, we have 500,000 people within 3 miles, and 66% of them are renters. So we're going to be heavily skewed with rentals on that one. Our one in Dayton is going to be a little bit higher skewed, like 50-50 for business, because it is more in the business district. The median income is a lot lower, and that's because there's a lot of businesses in there, and also the fact we have a lot of empty nesters who are, retired, so they don't have a lot of, W-2 income coming in, but but they're buying $300,000 and $400,000 townhomes across the street, and so it's that sort of relationship. But in each market is a little bit different, so you can't say that one is the same. But what we do look at is that median income will dictate what is the average size of our unit. So the lower the median income, the higher the premium they're willing to pay per square foot for a smaller unit. The more affluent, then they want they're willing to pay a higher percentage or higher premium for a larger unit, because I have to remodel my house, so I move out all my stuff into self-storage and they put it there for 6 to 9 months, and then they'll take up 3 to 8 lockers that are all 10 by 20.
Right. Oh, that's interesting. Well, Scott, this has been entertaining and informative. I've learned a lot on self-storage and it's actually I wanted to just mention, I would think that your training from being a student with a teacher that actually had a business, that you had an actual opportunity to have hands-on experience, real world. I would think that would have set you up incredibly well for what you're doing and that. And the last question I guess I have about that is, do you have any peers that you that came out of architecture school around the same time, that only had the theory, that that didn't have the hands-on experience like that? I just seems like your experience was kind of unique.
At the time, it was very unique, and I was chuckling a little bit earlier because you're one of the few people that find self-storage entertaining, so I appreciate that.
Well, I'm learning a lot. That's
yeah. But so my background was a little bit different because of the fact that my undergraduate was in. I have a bachelor's of bachelor's of arts from Kenyon College in history, and so I was the only student in the office who didn't have a BA in architecture. Mine was a master's of architecture. So what that really meant was that I could read a lot and I could, process a lot, but they were much better at drawing than I was much better with the financial side of things. And that's how I got put into the modeling of it. And so that was very unique in the sense. Now, there were other people that I know that have gone off to start their own business, but they have truly focused on more of the development side in terms of the traditional model of the apartment building or the condo, or just strictly stayed within construction. And that's where my focus has always been more on the development side in terms of the financials, putting together the structure and the deals. And so I did teach college. I was a professor of architecture at IIT for 5 years. And so, we really stressed in that class as well was being able to understand the whole project in its entirety, so you're not just pigeonholed into one little thing within architecture, but you have the ability to really utilize a broader base of tools and knowledge. And that was a curriculum that I got to work on for 5 years, which was fun.
No, that's cool. Well, Scott, I'm just looking on the clock here. We've been talking for quite a while here. And like I said, I found it entertaining, and I'm sure listeners will too. Before we wrap this up, where can the listeners go if they'd like to learn more and connect with you?
Absolutely. So our webpage is Coda MG, which is managementgroup.com. So codamg.com. And we do have the Facebook, and we do have those sort of references as well if you'd like to look us up there. But there is an info section, so if you fill it out and you can get it over to us, and we can begin the conversation that way.
Great. Hey, Scott, I want to say thanks again for taking the time. Like I said, I've learned a lot and enjoyed it, and hope we can do it again soon.
Very good. Thank you, Darren.
All right. And for our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.